Good morning, everyone. For those of you who already follow me on Twitter at Robert Hefner V or LinkedIn, you know I've been writing a lot more lately and trying to put myself out there. You also likely know that I am an extrovert. What you might not know is that it is quite terrifying for me to put myself out there on video or speak to large crowds. Over the last year, I have definitely been encouraged by friends and strangers alike to get out of my own way. So today, I'm going to try and put aside all my fears and start recording videos. I'm going to release one video per week on a subject that is hopefully timely for you and that I'm passionate about. Those will likely be the topics currently in the subtitle on this slide. Today, we're going to start with minerals and royalties. The goal is to provide quick and easy context for those interested about investing in this space. I'll also try to keep my videos very short to avoid rambling on and wasting your time. So, what are minerals and royalties? First and foremost, they are real property. That means that a mineral estate is identical legally to the real estate, the surface. That means that you can actually 1031 exchange between the real estate and the mineral estate. But to understand it, I'm going to continue this foil between real estate and minerals. The lessor is the landlord in real estate versus mineral owner in mineral estate. The lessee is the tenant versus the operator. And to continue that nomenclature forward, the mineral owner or the landlord leases a property to an operator or tenant who pays the mineral owner a monthly royalty income. So it's quite similar. Everything is almost identical, absent a few notable exceptions. The first of which is monthly expenses. If I own real estate and I own a building, let's say One World Trade Center over here, I actually have to spend money every single month to keep that building up. With minerals, you do not have these costs. Damages to property, unfortunately, we wish we could all say that we own property, real estate that doesn't have bad tenants, but if you're in the real estate game, you probably have at least one tenant who damages your property, whether intentionally or not. For that damage, if you're the real estate owner, you do have to pay to repair it, or you have to enforce a contract that you have with your tenant to force them to remedy the situation. Minerals, you do not have similar considerations. Insurance. Again, this is an area where if you own real estate, you're required to have insurance on the property. Minerals, you do not have similar costs. In fact, if you're the real estate owner and you own One World Trade Center, I don't know how many tenants they have in there. I don't know how whether they're at capacity or not. If you want to give an analog to minerals using One World Trade Center, the mineral estate is like having one tenant occupy One World Trade Center on a 999-year lease. And that tenant tells you, the landlord, I want to build. I want to not only improve your structure that you own, but I want to build 50 more floors. That is the equivalent of what horizontal drilling has done for the mineral and royalty estate. So again, there's a lot more to this. I could go deeper and deeper into it. You can go really deep into the weeds. But for now, suffice it to say, this is the very easy to understand overview of the difference between real estate and the mineral estate. The final thing I'll mention, actually not the final thing, but cap rate. That's a term that's typically used in real estate. Most of the investment deals that we're seeing here in Oklahoma on the real estate side for our family office is 6 to 8%. A comparable cap rate in oil and gas on the mineral estate is 12 to 20%. Meanwhile, you have the risk profile that approaches that of a bond. So very low risk, meanwhile, absurdly high returns. When you see returns like 12 to 20% on cap rate, you would imagine that those investments are risky. I'm here to tell you that that's not exactly the case if you know what you're doing and you're sophisticated in the space. Just like you wouldn't invest with a brand new guy trying to do a commercial 640-acre development that's never done it in his life, you don't want to invest in minerals if you've never done it in your life either, without help or without sophistication. We do offer those services. The last piece the mineral owner does own more than petroleum deposits. Most everybody refers to minerals and they talk about oil and gas. The reality is we also own everything under the ground, including the water, including iodine, of which there are major deposits in Oklahoma. I don't know what the actual number is, but I would venture a guess to say that Oklahoma iodine production satisfies at least 50% of the iodine hospital market. And then finally, rare earth metals, which are produced alongside petroleum in some cases. So that's what they are. Why are they interesting? Why should you care about this space? The simple answer is it has outperformed technology, real estate, and every other market segment since 2018. Now, this is an old slide that I learned was put together by Credit Suisse, but it was presented by my good friend Carl over at Haymaker Minerals at his Mineral and Royalty Conference in 2019. So what you'll notice here, though, and the point that I really want to drive home, is that minerals, while they are technically associated with energy, could not be any more different than the energy index or oil and gas operators in the charted against the S&P. So oil and gas and energy are net negative as far as total return since January 1st, 2018 through mid 2019. Minerals were doing very well. The only reason I am not bankrupt is because I own minerals. They are revenue only producing, and there are no costs associated with them other than the upfront acquisition, which is similar to a land deal. If you go out and you buy a commercial real estate deal and you're buying the land to develop, the only way you lose is if you buy wrong. You can't reset your balance sheet. You can't reset the cost of your investment. After that day, though, you have no more associated costs with owning at least producing minerals. There is one way, if you own unleased minerals and they propose a well on you, you can elect to participate, but I'll save that for another discussion. Another piece to drive home why this is an attractive space is information asymmetry and market asymmetry, for that matter. Populating on the left side of the screen, you're seeing what's called working interest. These are people that go out and drill wells. That is not royalties. So that space, by comparison, is very efficient. It's very competitive. Meanwhile, minerals are not, and I kind of divide them up among capital providing it or investment. So institutional investors, you've got the Canadian Pension Plan Investment Board, which backed Long Point Minerals, for example. You've got public markets like the publicly traded Kimball Resource Partners and Brigham Minerals. You've also got Long Point, which I already mentioned, Alliance Resource Partners, again, public, out of Tulsa, Oklahoma. They are a coal company that is diversifying out of coal and into minerals and royalties. And then you've got Kimball Realty Partners too. So institutional. You also have private equity. These are the guys that go out. They expect you to get 5x return in 5 years, and so their investment by nature is a little bit more risky. Some examples of private equity players in Oklahoma are listed there. And finally, you kind of have this friends and family area where these people aren't necessarily chasing high returns. Each one of these players can go pursue a more institutional strategy. And what I mean by that is institutional players require yield. They require cash flow. Pensions can't just give you money and not get any cash flow back. Similarly, your institutional players like a Franco-Nevada, which is a gold company out of Canada, they have done a joint venture with Continental Resources, and they similarly need that yield. So you can pursue yield, or you can pursue undeveloped, or you can blend those two strategies in minerals and royalties. But so this graphical representation of the minerals market is not necessarily representing the risk profile. It's just representing binning these together in 3 different areas. But what I'll explain here in a second is that the market got very frothy during the private equity years, 2016 through 2019 in Oklahoma. After that, in addition to COVID and the Oklahoma market being basically decimated by spacing assumptions not working out in the STACK And what I mean by spacing is number of wells that you can drill on a single 640-acre section. Those spacing assumptions just haven't worked out. The rock is not conducive to quote unquote manufacturing, or in the McKinsey world, just-in-time manufacturing, which is what this industry was billed as early on. And what's happened is most of these competitors have fallen away. They have not been active in the last year. So to graphically see that, you can see it here. The bar chart is the consideration paid in a given month versus the line chart being the count of deeds, the mineral deeds that were filed along the way. So from 2000 to 20, we'll call it 2015, it was largely, I'm even going to back up further. From 2000 to 2005, very small. What happened around 2005, 2007 is horizontal drilling in Oklahoma started to occur. That drives CapEx, and that CapEx drives velocity of dollars and discounted cash flows. As a result, people started investing more. You're seeing that bar chart go up from, call it 2008, 2007 through 2015. During that period, it was early time. Private equity had not jumped into the space. But on the heels of a very famous IPO being that of Viper Minerals, they institutionalized the space, and a lot more of that private equity started coming in. That started occurring, at least in Oklahoma, circa 2016, and you can see it all there. 2016 through 2019, the market got very frothy. Prices per acre were transacting above $40,000 an acre, from levels, if you were in 2005, you're spending a couple $100 an acre by comparison. And then, of course, we all know what happened with COVID, and everything, the entire market fell apart through 2020. The crazy part there is only $111 million were transacted in 2020 in Oklahoma. That is by comparison to over $1 billion spent every year from 2015 through 2019. So this is a brief overview of what minerals are and why they're attractive. The lack of competition in this space should be attractive to any investor. The lack of interest in oil and gas should be attractive to any investor. The information asymmetry should be attractive to an investor. And moreover, the market asymmetry should be attractive to any investor. So for those thinking about minerals and royalties, it is an incredible space where you are only cash flow positive the day after you invest, and it's not possible to be cash flow negative. If you have any more questions, I hope you reach out to me, Robert Hefner. Email is listed there, phone number as well. Some of our sites, Hefner.Energy is one of my companies. Adam OKC is our business organization, and I am on the board of Children's Hospital Foundation. We do thrive and exist almost entirely, it feels like, on charitable donations. If you're not familiar, I hope that you take some time to go familiarize yourself with the Children's Hospital Foundation. Thank you. Have a great day.